Hello, everyone, and welcome to our complimentary virtual seminar on tax planning for retirement. We're delighted to have you join us as we discuss this important topic in planning for your future. I'm Sal Carrera, Development Director for Vegas PBS, and Vegas PBS is committed to engaging the community with experiences that educate and empower individuals. Seminars like this couldn't be possible without the support and expertise of our Plan Giving Council members who lead these events. Today's seminar will be presented by three trusted and well-respected members of the Vegas PBS Plan Giving Council, Russell Cost, Scott Taylor, and Kim Walker. As we get started, I want to take a moment to quickly share today's format. Today's seminar will be presented in three segments, with each presenter giving a short presentation on the topic of tax planning in retirement. I'd like to start by introducing our first presenter, Mr. Russell Cost. Russell Cost has, for 34 years, he's been a fundraising and gift planning expert. He's also certified in fundraising. He's a certified fundraising executive as recognized by the Association of Fundraising Professionals. He's currently serves as the principal consultant with A Rising Gift Tide, where he enjoys helping charitable nonprofit organizations establish and enhance their fundraising efforts. Please welcome Russell Cost, who's going to be presenting on charitable gift annuities, securing a retirement income while supporting your philanthropic endeavors. Take it away, Russell.
Everyone, welcome aboard. I'm going to talk with you today about how to secure a retirement income while supporting your philanthropic endeavors so that you can better understand what's going on. I'm going to focus on the PowerPoint slide deck that I have, and I'm going to turn off my picture. I'm sure I'm handsome enough. So let's jump right into it. There are three ways of giving. Now, this is the commercial portion of my presentation. That is specific to Vegas PBS and the other wonderful charities in Las Vegas that I'm sure you're all aware of and would love to support. We're going to then talk a little bit about specifically about charitable gift annuities, the opportunity to provide yourself with a retirement income, a fixed income, and support charity. Specifically, we'll talk about immediate and then deferred gift annuities, which is a good retirement planning tool. And then I'm going to mention IRA rollover, also known as a qualified charitable deduction. So let's jump right into it. There are three ways of giving that everyone can take part in. First and foremost, give now. Give cash. Do a qualified charitable distribution from your IRA. Give assets. Assets are generally the biggest portion of our wealth. They comprise, maybe comprised of your house, your retirement fund, your stock portfolio, bonds, mutual funds, real estate investments, you have them, or if you're very successful in the world of business, your business or a portion of your business. Give later. How much later? When you've passed away. A gift through your will or trust, a beneficiary designation where you designate a portion of your retirement after it's been used by you and any successors or loved ones, your life insurance, or what we call a reserve life estate. My favorite quote is from Colonel Sanders. There's no reason to be the richest man in the cemetery. You really can't do much business from there. And then, of course.
Hi, Russ. This is Summer, your host. I just wanted to share with you that we don't see your slide deck. If you would like to put that back up for us, please.
Oh, sorry. How about now?
Bingo. Thank you.
Okay. I guess I have to leave my camera on. I'll figure out how to shrink that down. There we go. Let's get rid of that. Sorry. How about now? Okay, sorry. So we talked about give now, give later, and then of course give and receive, which is the focus of what we're talking about for the rest of the next 10 minutes or so. That's the opportunity to give a gift to a charity and receive financial benefits from it, lifetime income from a charitable gift annuity, a charitable remainder trust, or a pooled income fund. So let's talk about giving and receiving, making that charitable gift and receiving ongoing income. Today, we're going to focus solely on charitable gift annuities. So what is a charitable gift annuity? Charitable gift annuity is in essence a fixed, simple contract between you and a charity. It's a simple arrangement. There are no costs to establish it and no cost to maintain it. You give a gift to the charity promises to pay you a fixed income for the rest of your life based on certain factors. So who would be attracted to this? Who's this for? It's for people who own assets that you want converted to income payments. If you own long-term appreciated securities, it's a tremendous opportunity for taking advantage of converting something that's earning but not paying you. If you're looking to avoid market volatility, certainly a relevant topic over the last week. And you feel like the certainty of a guaranteed income, which as I get older, I'm looking at saying, I want to make sure that, when I'm hitting 75, that I'm getting the same amount of income that I'm getting now. And because I'm so inclined, it'd be nice if Uncle Sam paid a portion of this by giving me a charitable deduction for what I'm giving. So let's jump right into it. Let's talk about what comprises an immediate charitable gift annuity. How does this work? Well, simple. The donors transfer cash, securities, or real estate to a charity. As I mentioned, you can do this with cash, you can do this with stock, or even real estate. The charitable gift annuity is then arranged, and the donor, you will receive fixed income for your life or lives. You can have it for one person or for two people. The amount that you're paid is dependent upon your age and some other factors. And upon the death of the individual or individuals, as I mentioned, two that receive the income upon their deaths, the remainder goes to charity. So this is, in essence, a deferred gift for the charity and income for you in the meantime. You'll notice the notes, these are the legalese, the payout rates, the deduction, and other benefits, they all vary dependent upon several factors. Vegas PBS very wisely traditionally allocates all of its proceeds from charitable gift annuities to its endowment fund, thereby assuring a steady stream of income for Vegas PBS. So let's jump into an example. I have to refer to my notes. In this case, Helen is a 71-year-old widow. She'd like to make a significant gift. She has stock that she owns. She's owned for a long time. Her late husband purchased many years ago for about $3,000. Its current value right now is approximately $10,000. But it's not really providing much income. Right now, we have some stocks that are doing that. They're growing in value, but not paying a dividend. She's looking at this and saying, well, at the same time, I've been meaning to support, I've been giving to Vegas PBS cash, but I'm looking to do something a little more impactful, and I'd like to actually get a better return. So what does she do? If she sells it and then turns around and reinvests it on a commercial annuity, or specifically looking at income producing stock, well, the first thing that's going to happen is Uncle Sam is going to come out and take his share, $1,400 in capital gains tax. So her cash flow is reduced because she has less to invest. If instead she funds, because of her age at 71, a 4.8% gift annuity, that's the rate that is set. She gets the income tax deduction you see here of $4,300. She avoids tax on the capital gain of $3,000. And as you can see over there, where the most important part, the cash flow after tax and before tax, is substantially greater than if, one, she kept her her stock, and two, if she reinvested it on her own. There are some caveats, as mentioned down at the bottom. The timing and the amounts all depend upon the timing of the gift. And nevertheless, this is a very successful for the donor and for the charity gift that I had the opportunity to do numerous times to help a lot of people arrange this kind of gift for their benefit and the benefit of charity. The other type of gift annuity we're going to talk about real briefly is a deferred gift annuity. deferred charitable gift annuity, in which it is almost like an investment where if you're younger, say somebody in this case in their 50s, and they've got another 10 years, they're thinking I'm going to work, and they've got a stock portfolio outside their retirement plan that they've built up, and they're looking at it and thinking, okay, here's my return. This is an opportunity to improve on that, and it's, again, at the same time, help a charitable organization. So the donor transfers, just like a regular charitable gift annuity, transfers this cash, the securities, the stock, or the real estate to the charity. The charity invests the gift's assets for the donor selected deferral period. Now, what do I mean by deferral period? The donor says, I'm looking to get this income stream not right away, like the immediate charitable gift annuity, but in the future. How far in the future? Donor decides. 5 years, 10 years, 15 years, whatever time period the donor feels comfortable with. What happens to it? The charity invests it for that time period, and at the end of the deferral period, the donor then begins receiving that income just like a charitable gift annuity, a fixed period of payments. And something I didn't mention is these are traditionally quarterly payments. The annual amount is divided into 4 quarters and paid on a quarterly basis. And once again, like a charitable gift annuity, this is the same, it's just deferred. You can have it for a single life or for 2 lives. And it actually need not be married. You need not be a spouse. It can be a nephew. It can be a grandson. You can actually use these to structure a gift that will allow a grandchild to use it for potentially their college education. And then upon the death of the donor, the remainder then flows to the charity, just as the charitable gift annuity does. Here's an example we talked. I wanted to talk. I kind of led up to this. Forgive me, I got to refer to my notes about David. David, if I recall, is 55 in this example. Someone a little too far. There he is. He's looking at. He keeps 50 grand sitting in a CD money market, and what's he been thinking about doing? Well, you know, right now it's sitting there and it's not got any tax benefit. It's generating about $1,000 before income. And after tax, because, you know, when he takes it out, it is taxable, he's paying a 37% tax rate. So instead, he looks at funding a deferred charitable gift annuity, and because he's elected to defer it for 10 years, he gets the rate of 5.5%. He immediately gets an income tax deduction, which obviously reduces the amount he pays to Uncle Sam. His income before tax is $2,700, and after tax, he now gets $2,300. And you can see right there the substantial difference between that 630 and the 2322. Remember, though, something I want to emphasize, this is a gift to charity. So can this compete against a commercial value annuity? Not likely. It will be close, but at the end of the day, you're still giving away a portion of your assets to charity, but charity gets it after you're done with it. That's the best part. So that kind of covers what I was going to be talking about for specifically charitable gift annuities. Remembering what I said about the 3 ways to give now, give later, give and receive. This one is more about the give later, but it also has an option for give and receive, and that's called an IRA charitable rollover, also known as a qualified charitable distribution. QCD is the term we use internally. And this is a gift from your IRA. If you're over age 70 and a half, you are able to make a direct distribution from your IRA to a charity without any tax consequences whatsoever. Specifically, if you take a withdrawal from your IRA, you have to pay tax on it. And after age 72, now, it used to be 70 and a half, but after age 72, you are required to take distributions because Uncle Sam wants to get his hands on your money via taxes. So if you're over age 70 and a half, you can ask for your custodian of your IRA to make a direct distribution to a charity, Vegas BBS, directly to charity, and it is not a taxable event for you. There is no income tax paid because it is a direct payment to the charity. And this is a wonderful way of making a gift, and in many cases, well, almost every single case, satisfying your required minimum distribution if you're over age 72. The maximum you're allowed to do this is the maximum dollar amount is $100,000, and that's once per year. And it can be one lump sum or a series of payments, however you'd like. And it can go to of course, your donor's favorite charity. There's some specific steps you have to take. That the payment must go directly to the charity. It cannot come to you, because the moment it does, that's a taxable event. So I hope you've enjoyed what I've presented about qualified charitable distributions, and more importantly, charitable gift annuities. I'll be available for questions at the end should you have any, and there will be a handout that Summer and Vegas PBS will send you. Thank you.
No, thank you, Russell. Thank you so much. Very good information for all of our attendees. I want to remind all of our attendees that you can submit your questions that will be answered at the end of our presentations. We got 2 presentations to go. We'll get through as many questions as possible. They're already coming in. I'm getting questions from our organizer, Summer, that people are submitting through the chat feature. We're going to move on to our next presenter today is Scott Taylor. Scott Taylor is an office managing partner at BDO. He has over 30 years of experience providing tax services to different businesses. He also provides business consulting, deal structuring, receivership, and litigation support services for companies. He is affiliated with the Nevada Society of Certified Public Accountants, along with Utah and the American Institute. Please welcome Scott Taylor, who's going to be presenting on the individual tax law, tax planning strategies. Take it away.
Well, glad to be part of the presentation today. Just to double check, can everyone see my presentation?
Yes, we can.
Okay. So just to begin, my background, I do this my entire life for the past 30 plus years. So this is just wanted to give you some points of discussion so you can at least have an idea of what's happening in the area of taxation and retirement. So we'll kind of go through a quick agenda of that, and then hopefully we'll have some questions at the end that we can answer. So the first thing I wanted to touch base with is we've all probably seen in the media, there's a lot of things that are being changed right now. There was discussion that things were before the House and they were accepted, and then we all of a sudden heard through the media that everything had been passed. However, it was stalemated in the Senate. Therefore, there really was no tax law changes in the current year. So all of our discussion right now is still centered around what's called the 2017 Tax Cuts and Jobs Act, which was passed on December 27th of 2018. So we've had this law in place for this period of time. So we're going to talk a little bit about some of the effects that has on our retirement. The primary effect is there is discussion through the media and through the House and the Senate that there's potential things that will be proposed and changed. So just kind of keep in the back of your mind that this is the current law we're talking about. There's lots of things that will change, and we'll talk a little bit more about how that affects us as individuals. The first thing is you kind of see, in order to control your tax issues, you've got to sort of watch what the marketplace is. So these are just some ideas of, how do we proactively be part of that process. First, you need to be talking to your tax advisor. You need to pay attention to what's actually past law and or proposed law, and just be aware that sometimes you get information that might say there's an effective date of a new tax law change. So just be careful with that. And you talk with your advisor or look at your detail of what you file on your taxes to find out, how will this affect me? We'll talk a little bit more about that. One of the biggest things, and Russ mentioned this a couple times in his example, is currently the highest tax rate is 37%. I'll show you some brackets here in a few minutes, and we'll show how that really works, because 37% is the highest income tax bracket. A lot of people are not in that, so I want to show you how that works. There's discussions that those brackets will likely change, so just be prepared for that happening. And the reason why I pop up this expectations and speculations is because those marginal brackets determine a lot of things that affect our retirement. One of them being how much is taxed of your Social Security and so forth. We'll talk a little bit more about that when we see the rest. And everything that we have sort of limits or tests based upon what's called adjusted gross income. That's when you see the acronym AGI, that's what that is. So we'll go on to some of the biggest things that we have right now, and I've highlighted a couple that are really important because I talk about this all the time, but the charitable deductions is the biggest thing. Russ talked about the qualified charitable distribution, which is a vital way to do it, but most of the deductions that everyday Americans had were changed a lot under the Tax Cuts and Jobs Act, which most charitable deductions are considered itemized deductions. However, during the CARES Act, during the pandemic, they changed to allow a portion of your charitable deductions to not be an itemized deduction. So that's probably the biggest thing to note, is even though you may have some charities that you might do a little bit of donations, philanthropic needs during the year, you can still take what's called an above the line deduction for the charitable deductions up to $600 if you're married, $300 if you're single. And that goes on page 1 of your tax return, so be aware of that. You can also convert your 401ks to a Roth. Those are a big thing that adjust your adjusted gross income. And the importance of, I highlighted reviewing your AGI to determine where you at with certain thresholds. That's really important. So rather than just relying on, how your tax software might work or what your CPA does, just kind of remember that AGI is a testing point for almost everything we do. For individuals, I wanted to show you kind of how the marginal tax rates work. And I like to see this so you can kind of see how the brackets work right now. What's being discussed right now, and we'll just talk about the married filing joint rates for right now, because single ones are pretty much half of that. So if you look at the way these rates work, up to $19,900 in 2021, you're going to pay 10% marginal tax rate. So when we're talking about what's this going to save you for what you do, this is kind of what we're talking about. If you're inside the second tax bracket, which goes from $19,009 to $81,000, that's what gets taxed at 12%, and then the next rate goes to 22%. That's how these work for the marginal flows up to that maximum rate of 37%. So just kind of think of the graduated marginal rates. This is where it flows when we talk about this, the way it flows upstream. I like a picture that I have, just so you can kind of know. These PDFs will get provided to you by summer. So if you forget something, it's not a big deal. Look back at the handout a little bit later. I like this picture. I got it in a class that I took a couple years ago. I like the way it looks, even though these are the 2019 rates. I like the way it sort of portrays how you go forward with the tax rates. So the triangle is kind of helpful. You can see down at the bottom, most taxpayers pay tax at this rate, and as you go up the triangle, that's where you pay a higher marginal tax rate. I just like the illustration of that, but it's really pretty much the same thing as that previous sheet with the marginal tax rates. It might help you with planning. Because every time you get a deduction, it's going to affect you whatever marginal rate you're at. First thing to remember is under the Tax Cuts and Jobs Act, the standard deduction changed significantly. That's why a lot of people don't, if you're retired, you've already paid for your house, and so you don't have a mortgage, and you're probably going to take the standard deduction. And it goes all the way up to $25,100 this year for your deductions. The reason why that's a big deal is because in years prior, we always had a personal exemption as being part of the deductions against our income. So this is really important because most people that don't itemize anymore, you're going to get a flat deduction of $25,000 if you're married, and you're not going to get a personal exemption. So just remember that. That's what we're talking about with this tax act. And almost everything that's part of higher income has a phase out, and that phase out is related to itemized deductions and adjusted gross income, like we talked. I'm going to skip this part because it doesn't relate to you guys. It's not part of our subject. But the biggest deduction that we have is probably the state income taxes related to real estate, which makes you itemize. Excuse me. But one of the biggest deductions that we have as part of our itemized deductions, if that's part of what your plan is the charitable contribution. They're limited to 50% of your adjusted gross income, which under the Tax Act moved it to 60%. So just in the back of your mind, when you're talking about charitable deductions, if you don't take what's called an above the line deduction, like a qualified charitable deduction, this is what they're talking about. If your income happens to be a low year, you're limited to that number. For example, if you have a $10,000 adjusted gross income, you'd be limited to $6,000 of a deduction as an itemized deduction. However, if you have, that's all the deductions you have because you don't have a mortgage, you're going to still take that standard deduction. So just keep that in mind. So there's a few things that this chart helps display a little bit about, what the projection is for going forward with adjusted gross income. Everything is related to AGI. So be aware of that. And you can look back at this since we're running short on time a little bit. So the first thing you need to do is figure out whether you're going to be taxable on your Social Security. So all taxpayers, if you're over a certain level of adjusted gross income, which is about $32,000, is going to get taxed 85% on your Social Security. Social Security, to figure out how much you're going to receive for Social Security, you need to coordinate with Social Security Administration by signing up online or paying attention to those mailers that we all get in the mail. So be aware of that's how Social Security is calculated. You can't really go to your CPA and say, how much is my Social Security benefit going to be, because it's coming from the administration. They'll be able to tell you how the tax is on it, but not necessarily what the physical dollar amounts are. You get that from SSA online or through their mail. Russ has already talked about the qualified minimum distribution, but I wanted to illustrate to you what that really means. Is if you want to contribute to a charity, this qualified minimum distribution is super important because we're all required when we reach the age of 70 and a half and 72. That was the law change that moved to 72 for not taking RMD contributions or distributions that have to be taxable. For example, my father is that age, and he always does a qualified minimum distribution because dollar for dollar that becomes non-taxable. So not only do you get the standard deduction still, but now you don't have to pay tax on that IRA distribution, which would be taxed according to those marginal brackets that we discussed earlier. So it creates a double benefit for you because it reduces your AGI, therefore reduces your Social Security that's taxable, and also helps you stay involved in your community with being philanthropic. So one thing that we didn't talk about earlier was RMD is calculated based upon the account balance that you have the year you turn 72. So it looks at life expectancy factor. Normally your administrator of your plan coordinates that. So just be aware that that's how that coordinates. We're going to go through this very quickly because we're running out of time, but the charitable contribution strategies is super important to figure out when you're going to make that deduction. You have to coordinate if you want to be a qualified charitable distribution prior to the end of the year, and the physical push of the button needs to be done before December 31st. So something to plan for. If you want to do it every month, you can coordinate it. Just don't wait till the last minute where your administrator might not be able to coordinate that. That goes for whether you're doing a gift by check or credit card. It needs to be by the date you submit it. So just remember the date of submission is important for that charity. We've already talked about the timing and the marginal brackets. So we'll skip that. And I'm not going to talk about private foundations since we're out of time, but it's in your detail. We're not going to talk about capital gains. And I'll turn the time over for questions at the end. I'll turn it back over to you, Sal.
All right, thank you so much, Scott. That's a lot of great information for all of our attendees today. Thank you so much for taking the time to give us all that great info. Just another friendly reminder that we've got time for questions at the end, so we want you to use that chat feature. You know, you've got experts here, willing and able. No question is a bad question. Go ahead and fill out those questions in the chat feature. We're going to get to that at the end. Let's see. Thank you for those of you that have been submitting those questions. We've got a nice list of questions for the end of our session today. We're going to move on to our final presenter. Today is Kim Walker. Kim Walker is a certified public accountant with over 35 years of experience. She represents the small business community of Southern Nevada, Western Arizona, and Southern California, helping businesses with their tax preparation, entity selection, and business startup, and IRS problem resolution and bookkeeping. Kim is native to Las Vegas and graduated from Bishop Gorman High School. She then obtained her undergraduate degree in accounting from Santa Clara University and continues to further her business growth. Please welcome Ms. Kim Walker. She's going to be presenting on current status at the IRS, tax legislation, and selling your home. Take it away, Kim.
Thank you so much, Sal. Unlike Russ and Scott, I have no slides, so you're stuck looking at my fat face for the entire 15 minutes. Let's talk about selling your home. Over the last 30 or so years, we've had 4 at least different tax laws related to how the sale of your home is taxed. All of those prior laws don't apply, but for people that were familiar with them, they still hang in their head as the current law. For example, people still think that you have a once in a lifetime exclusion on the sale of the home, and that is an outdated law. So what is the law? Today, you can exclude up to $250,000 if you're single, or $500,000 if you're married filing joint of the gain on the sale of your house. Let's give an example of that. If you bought your house for, let's say, $100,000, and some number of years from now, it sells for $800,000. Initially, you're going to have a $700,000 gain, not taking anything else into consideration. Your potential shelter on that gain would be either the $250,000 or the $500,000, and you would be taxed on the excess. Now, there are again some limitations on when you can use that exclusion. You must have lived in the home for at least two out of the last 5 years. If you bought the home, we'll call it you bought the home 10 years ago. we're going to look at just the last 5 years. If you lived in it for 2 of those last 5 years as your personal residence, you're going to qualify for the exclusion of up to $500,000. Sometimes people will rent out their home when they relocate. They want to test the water, so to say. They want to see if they like being a landlord. Does the rental property benefit them? And they might rent it for a year or 2 and then decide to sell it. We're going to again take a look back for them out of the last 5 years. If it was rented for 2, they still lived in it for 3, so they qualify. If they rented it for 4 and they only lived in it for 1 of the last 5 years, they're not going to qualify for that exclusion benefit. So it's important to look at that, especially if you're relocating or downsizing to a smaller home. If you're looking to rent your prior home, especially, you want to consider that 2 out of the 5-year issue if you decide to sell it in the future. Also, living in it for 2 years, it does not have to be contiguous. You can live in it 1 year, relocate for a few years, move back to it for another full year, as long as we're in that 5-year category, and that exclusion will still apply to you. So the 2 years does not have to be a continuous stream of time. The other thing about selling your house is we are concerned now about the basis. The sales price minus the basis is going to be the original gain that we look at. What is included in a basis? Obviously, the original purchase price, but there's also going to be expenses like landscaping. In Las Vegas especially, we tend to buy houses that have dirt lots in the backyard. Landscaping adds to the basis. Putting in a pool, putting built-in cabinetry in closets, dens, those all add to the improvement or basis of your home, and you should keep receipts on the improvements that you do in your home. If you have an audit ever to substantiate the basis, you will need to have those receipts in order to satisfy the IRS audit. Can you ever get through an audit without those receipts? It's very, very tough. I think the best thing to do is to start out saving the receipts. If you're already behind the 8 ball and you have not saved receipts and you're going to be selling your home soon, you want to make sure your basis is correct. An option that has worked, but certainly no guarantee. I had a client once who did not keep all of their receipts, but had photographs of the original backyard. And then they were smart enough to photograph the progress of the pool that was put in and the landscaping work that was done. That combined with some of the receipts, the auditor allowed their basis, but certainly that's not what we want to rely on. You want to keep your receipts. So that original purchase price plus any and all improvements that you make on the home, that summation number is going to be what we use to calculate the gain when you sell the house. If we're talking about selling a rental property, we're going to use the same method for calculating the basis, but for rental properties, you can't use an exclusion. The gain is going to be 100% taxable, unlike with the personal residence. However, you do have an option of doing a 1031 exchange when you sell a rental property. It's a little complicated to go into in this short seminar. Just in general, keep in mind that when you sell a rental property, if you take the proceeds and transfer them entirely into a replacement investment property, most likely you will qualify with a 1031 exchange and the gain will be deferred, not eliminated, just deferred until such time that you sell that new replacement property. So for personal residence, we're looking at an exclusion of up to $500,000 on gain. For rental property or investment property, you have the option of 1031 exchanging them. to defer gain, not avoid gain. Then let's leave that at that. We'll move on to, I just want to bring you up to date on the current status of the IRS. It is abysmal. They, as of this last week, have an estimated 10 million tax returns that are still waiting to be processed from prior years. That includes amended returns, paper mailed in returns, payroll tax returns. We're finding that taxpayers are waiting up to 10 months to get refunds back on their returns. In addition to the backlog of the tax returns that haven't been processed, we have approximately 5 million pieces of correspondences that remain unopened. That would include letters that we send to the IRS in response to assessment notices, inquiries, elections of all different sorts for businesses. And as you can imagine, it is extremely frustrating because taxpayers aren't getting resolution on issues that matter. Why is the IRS so inefficient? Well, a couple of things. Number one, all of their offices have been closed for the past 2 years and remain closed for the most part. Agents are working from home. 20% of the workforce is out due to COVID issues. In addition to that, a lot of their older employees have used the last 2 years as an opportunity to retire. They are not finding that they can replace those retirees with new hires. Recently, they sent out recruitment letters and opportunities for 5,000 slots, employment slots. They only filled fewer than 200 of those. That should give you an idea of how understaffed they are. Plus, their technology is severely outdated. Their computer systems are old. They can't scan or email, and their networking features are antiquated. On top of all of their own internal problems that were there to begin with, we added to their responsibilities the job of sending out stimulus money over the last 2 years, which they were ill-equipped to handle. That put them farther behind. What can be done? Not really much if you're a taxpayer, except having patience, staying on task with repetitive correspondence, in some cases contacting the taxpayer advocate office, although they are a little backlogged there too. I think the important thing that I always tell people is that when Congress recently asked for more money to fund the IRS, they didn't ask for the money to be used for staffing and technology upgrades. They used it to staff more auditors. It's hard to sell me on funding for more auditors. I would prefer to send money or fund money to the IRS to upgrade what they already have, make them more efficient, bring them into the 21st century with their technology. So staffing and technology, I would say, put us behind. That is all I have to say today on that. Sal, thank you.
And I'm back. Thank you so much, Kim. Lots of great information there. And, just want to remind everybody that we've got experts here. We've got experts. No question is a bad question. So you're still time to get your questions addressed by posting your question in the chat feature like we did earlier on in the program. We did have several questions. So we've got everybody up. Yes, we do. So why don't we move on, Russ? I think the first question is for you. That question came in the form of, I think they were talking about the subject you were talking about, charitable gift annuities and qualified charitable distributions. How do you do these? Through the charity, through the broker? Can you use your existing IRA? What's the answer?
Great series of questions and certainly appropriate. So the charitable gift annuity is actually a contract specifically between you, the donor, and the charity. So you do it through your charity, the charity you choose. It's exclusive to that charity. That's the first question. It's not through a broker. It is not a commercial annuity per se. It is actually mandated by state law. It's between you and the charitable organization. So that answers that question. Question about and should you be interested in helping Vegas PBS? First two people you want to contact are Sal and Jim Ludwig. Two experts know how to walk you through the process. Vegas PBS has made a wise decision. They use a service provider, Charitable Gift America. They do a wonderful job. The gentleman who founded that company I've known for over 25 years. He's one of the best experts in this particular arena. How about charitable gift annuities? Question I saw was also, can you use your existing IRA? As a matter of fact, you have to use an IRA to transfer I misread the question. So can you use your existing IRA? I'm kind of assuming that's possibly for the qualified charitable distribution, because you can't transfer assets from your IRA directly to a charity and establish a charitable gift annuity. You will realize a taxable event because you're basically turning it into income. But specifically as it relates to the qualified charitable distribution or the IRA rollover, it has to actually come from your IRA. If you have a 401k or a 403b, other kinds of retirement plans, those have to be actually transferred to an IRA, and then your IRA custodian can then transfer it to the charity. So I invite Kim and Scott. Scott, certainly, both of them are experts on this part, on the tax part.
I think the key is the administrator at the IRA should be the one. There's a form that gets filled out to make sure that there's a documentation trail, and they physically designate which charity to give it to, and the check goes directly to them. Doesn't touch your hand at all, directly to them.
Wonderful. Kim, this next question is for you. It's regarding the sale of a home. It says, do I need to pay taxes on the sale of my second home?
You absolutely do. That exclusion of $500,000 is limited to your personal primary residence. A vacation home is taxable. Yes.
Thank you. And let's see, the next question. What are the tax implications of converting my 401k to a Roth IRA?
Taxable, and that goes back to the marginal brackets that you have. If you have a year where you don't have much in income, the tax effect might not be as great as in years where you have a lot of income, because it's marginal taxable income. If you have losses come from somewhere, it might be a good time to convert, because then there's no tax because you have losses that absorb the taxability. So sit down with your advisor and coordinate.
Anybody else have anything to add there? Okay, let's see. Can I give stock out of my IRA to charity to avoid capital gains taxes?
Go for that one. Can't think about that one.
Yeah, yes, you can.
And the good thing about that is you don't pay tax on the appreciation of it, but you get the fair market value of the deduction. So it's a good thing.
Excellent. Let's see, what do we got here? What are your suggestions for reducing my taxes? What is the easiest way to reduce my taxes?
I got that one. And make less money, but that's not fun.
Okay.
I would just add, being careful with what is reportable as taxable income and what's not, and what's included in your adjusted gross income and what is not. So tax exempt interest is a good way to do it. Qualified charitable distribution is a way to reduce that. Lowering the effect of what Social Security is going to be taxed at. All those things sort of play into it.
Also, too, I will add to that, that question is perfect as a segue to sit down with a professional, a CPA, to review what you have, especially this time of year. We have so much time left in 2022 that decisions made today can really help to reduce your income for this year and your taxes. The time that we can't be as effective is January 1 of next year. It's too late for this year. If you have questions about this year, call someone.
Yeah, I call that letting the cement set. Once it sets, you can't do anything about it. So do it while it's still fresh, where you can trial it.
Yeah, and to that point, Kim, I wanted to make sure that everyone knew that the presenters today are offering initial complimentary consultations to those that are interested in scheduling an appointment. So to schedule an appointment, please stick around, and as the presentation concludes, you're going to have an immediate chance to access our survey, which then gives you opportunity to arrange for an appointment. Okay, just want to make sure everyone knew that. We still have some more questions, and we still have some more time, which is fantastic. Let's see. Are there minimums in terms of setting up charitable gift annuities? Does it depend on the charity?
The answer is yes. It does depend on the charity. A variety of charities establish a minimum. For example, I know of universities that will set it at $10,000 for the initial charitable gift annuity, $20,000. Vegas PBS, the minimum initial contribution for a charitable gift annuity is $10,000. I know of other organizations where it's as high as $50,000. What's nice about that amount is, while once you set up the first one, the second, any subsequent charitable gift annuities are available at lower amounts, i.e. $5,000 or $5,000 or less, and it sets up the opportunity for a strategy that we call laddering. Each year, as you get older, the rate that you receive gets higher. I've worked with several donors that through the years, every single year on the day after their birthday, they would literally call and say it's time for another $10,000 because they wanted that extra increase. So they built up a portfolio with some charitable gift annuities paying 5.5. The next year it was 5.7. The next year it was 6.0. So it's a wonderful way.
Okay, and we've got a couple more questions that came in, and luckily we have some time still left. What do I do if I received a stimulus payment for someone that is deceased?
Want me to take that, Kim? That's a tricky thing, because I have circumstances where the IRS has given things that are incorrect. And the technicality of the law is, if they give you something incorrect, you don't have to give it back. But it's a little bit tricky, because there's really a difficult way to give it back. Some advisors are saying, if you get something from someone and they don't have a proper estate set up, you should send the check back. But if it comes to you and maybe one of your kids, they gave it to you wrong because your kids were calculated wrong, you technically don't have to give it back. Do you know anything different than that, Kim? That's what I read.
I think that was a great answer.
A little tricky. To claim it is another tricky thing, because the forms are not very easy, and they're not really tax forms, but yet we're the record keeper and the provider of data to the IRS. So keep your letters that you get from the White House, keep your letters that are given to you from the IRS, because those are vitally important to document. If you got shorted, you can claim it and get more. But if you get too much, you don't necessarily have to give it back.
Thank you for that. I've got a question here, and it's once you're retired, you basically have a fixed income. How do you make sure that you set yourself up to account for inflation?
I'd like to jump in on that one. There's actually a couple of different ways in which you can do that. Remember when I mentioned about give and receive? There are a couple of different options, what's called a charitable remainder trust, charitable gift annuity, which we discussed, and a pooled income fund. I happen to know that the service provider, Charitable Gift America, offers what's called a pooled income fund that will actually start at a minimum payment, or sorry, a minimum payout of 5% of what you give, and then actually improve through the years. It's what's called, it's literally technically called a pooled income fund. The name of their fund is Gemini 1. I believe it's named after the rocket, actually, but it is actually unlike a charitable remainder trust where you pay substantial legal fees to establish a charitable remainder trust, and then you have to oversee all those investments. A pooled income fund is like a share of a charitable remainder unit trust in which you only have to buy a certain portion. In other words, you're making an investment, and it's the same premise. You get an income stream for life, but this one is actually variable. It has a floor of 5%, but it can go up. It won't go below 5%, it will go up over your lifetime, and you can offset inflation with that, and you get a charitable income tax deduction. Greater details available through Jim and Sal and the provider, Charitable Gift America.
That's wonderful. Thank you. Thank you, Russell. Thank you, Kim. Thank you, Scott, for all of the information that you've given to us today and to all of our attendees. Thank you for coming. We're running out of time, so I would still submit questions if you want, or what you can do is stick around for that survey to deploy, and you're going to get a chance to set up schedule a meeting with our presenters. They have a lot of wisdom, a lot of knowledge that they just shared with us, but I'm sure that everybody's individual case is a little different, so you might need that consultation. So everyone who joined us today virtually, please save the date of April 28th, 2022. That's coming up here, and you want to make sure that you save that date because we have another plan giving seminar on aging alone and guardianship. And we, if you've missed some of our plan giving seminars, they're also at vegaspbs.org. There's videos of our past plan giving seminars there in case you want to check out our library. And we've run out of time. So thanks again, everybody. Thank you so much for participating today. Until next time, take care and have a wonderful day.